Okay, guys, we're gonna go ahead and get started. And game plan for tonight is to get us through chapter 1 for sure and make some good headway towards finishing up chapter F2. Before we do that, though, I do want to share a concern that I have. When I'm looking at e-learning and I see something like this, that I had an assignment that was due March 14th, and I've got close to half the class not turning it in, I think I have to stop and spend a couple seconds to ask what's going on here. And obviously the people that turned it in don't have to answer that question.
Well, I didn't even know we had an assignment due that soon. I was always focused on the April 25th date of the one that you talked about before, so.
Okay.
Yikes.
Okay, well, I'll open it back up because I don't even know if it'll let you submit it now. But, we want to make sure that we're paying attention to when things are due, that we're keeping up with the homework, that we're coming to class. I'm showing 24 participants right now out of 30. So that means there's 6 folks that are deciding not to come to class here so far anyway. Maybe they'll show up. Again, I want to reemphasize, you do need to be getting into those homeworks, the Becker homework, looking at those questions, trying to keep up with things. Just don't feel like you can just sit there and kind of ride in the back seat and not do anything and get an A. That's not the purpose of this class. And if that's sort of what you're looking for, you need to kind of go find it somewhere else. This is not just points that are given for nothing. Okay, so you want to, grades that are given for nothing. So you want to sit there and you want to make sure you're doing the things that I'm asking you to as you go along, okay? Because I will be checking your progress through the navigator here pretty quick, and I don't want to always be in the business of, hey, where were you? What happened? You know the schedule, 5 to 8, Tuesday, Thursday, turn the things in when they're due, make the best progress you can towards the homework, okay? So I think I've got to go in and adjust this. I'll do this later so that you can turn this in, but at some point I'm going to cut it off. And that's a good chunk of your grade. Let's not start making mistakes like that, okay? Any question on that? Okay, good. So let's go ahead then and let's jump ourselves in. My recollection, we were stopped at module 7, okay? And we're going to start to talk about our comprehensive income. Okay, so let me just fix this and put this at full screen. All right, and let's go ahead and see what we're dealing here when we talk about statement of comprehensive income. So what happens? Well, for years, what happened is the FASB decided that there were times that you would make a change to something on the balance sheet, and that change to something on the balance sheet wouldn't affect net income, okay? And users of the financial statements sort of started to get a little bit upset with the FASB because they're saying, well, we really want to understand how changes to things that happen on the balance sheet would affect net income. On the other hand, you had some companies saying, well, no, we like the way we calculate net income. We don't want to run everything through the income statement. So what FASB did is came up with this notion of comprehensive income, okay? And so what comprehensive income now constitutes is your net income, and that's reported straight on the income statement, okay? And then they're going to take a variety of things that weren't traditionally reported on the income statement and say, this is how those things would have affected your net income had we run them through the income statement. And they called those things other comprehensive income. So you take your traditional net income, you take these other comprehensive income items, you add those together, and that gives you comprehensive income. So you know you're becoming an accountant head when you can sit there in this world and say, well, comprehensive income is net income plus other comprehensive income, right? Okay, now net income, we know from our earlier discussion from this chapter, includes the, and just thinking of the sections of the income statement, we had what? We had our operating items, non-operating items, tax, that composed my operating income. And then I had what? Potentially discontinued operations I would report down there. That was basically how I calculated my net income, right? Then what? Then we take these other comprehensive income items, we add them to net income to come up with comprehensive income, okay? Now, we give you a mnemonic here for the nature of things that constitute comprehensive income, okay? So one is the pension adjustment, okay? Just going over to the next page, unrealized holding gains and losses, foreign currency items, okay? Instrument specific risk, effective cash flow hedge, and revaluation surplus, to help you to remember the things that constitute my other comprehensive income, and that gives you the mnemonic puffier, okay? Now, we deal with the full lecture on the nature of these things that constitute other comprehensive income as we come to those subjects, and we talk then about how they affect the other comprehensive income, okay? So I'm not going to get into those now, because what I want you to do is flashcard up here, okay? So comprehensive income is what? Is other events and circumstances from non-owner sources. It includes all changes in equity during a period except those resulting from investments by owners and distribution by owners. So what I want you to put down here in the flashcard is what constitutes comprehensive income is anything that changes equity except for what? Not stock sales and not dividends. I think that is the better way to remember this than trying to sit here and have this weird definition or try to remember all the elements of puffier. Better to just remember that comprehensive income is anything that changes stockholders' equity, unless it's what? An investment by owners, which is stock sales, or a distribution to owners, which, hello, is what? Dividends. If you remember it that way, that's what constitutes my comprehensive income. So net income changes stockholders' equity, and what? And these other comprehensive income items, the pension, et cetera, affect my comprehensive income. But just remember, it's not dividends, it's not stock sales. Okay? Question? All right, good. Now you come over and you take a look at a couple things about definitions related to other comprehensive income. And you have something called accumulated other comprehensive income. And what I want you to put there is accumulated other comprehensive income is like RE. Okay, it's like retained earnings, but it's the retained earnings of my other comprehensive income. So when I close out my net income each year, I close it out to what? Retained earnings. When I close out my other comprehensive income items, I report that out to, I close that out, I should say, to my accumulated other comprehensive income. Okay. And then we're going to see that we're going to be learning something about reclassification adjustments, but I'm going to come back to those after I go through a couple of other things with you. So I'll come back to that. But let's just take a look at how I will report my comprehensive income, okay? And there's two different approaches that I can take to reporting my comprehensive income. One is the single statement approach, okay? And I'm not going to go through the details of this exercise. I'm just going to show you what it looks like. In the single statement approach, okay, why don't we go ahead and just make that clear that we're talking about the single, that's a single statement approach, okay? And when we're talking about the single statement approach, what do we have? We've got our revenues, we've got our expenses, we've got our net income. I guess this entity didn't have any discontinued operations, so they just got the net income. So that's the income statement, right? And then what they do under the single statement approach is they just tack on the other comprehensive income items, whatever they are, pension, etc. And what? You take your net income plus your other comprehensive income. They called out the items here, they constituted that. That gives me comprehensive income. So they sat there and just tacked on the other comprehensive income items onto the bottom of their income statement. That's called the single statement approach. You could take the two statement approach. And what you do with the two statement approach is what? You sit there and you have your income statement. You just leave your income statement alone. You have this part as your income statement. And then you pull out a separate piece of paper and you create a comprehensive income statement, which is going to do what? It's going to start with the net income, which got pulled down from your income statement that you left alone. You didn't put the other comprehensive income items on there. And then you call out the other comprehensive income items. So you've got what? I call it the two piece of a paper approach versus the one. One, you report everything on one single sheet. The other one, you have your income statement, and then you pick up your net income, put it on page 2, and that becomes your statement of comprehensive income as you call out your comprehensive income items and how they affect net income. One statement approach, two statement approach. Any question on that so far? Okay, good. Now what I want to do is I want to stop before we get into some of the more detailed items here. And I want to direct your attention to e-learning under chapter 1, okay? And where are we? Chapter 1 here. And I have a couple of documents here for you, okay? And the one that I'm going to open right now is this other comprehensive income example one. There really is only one example. And let's see. I guess they're going to make me download it. So I guess I'm going to have to. I guess I don't have it here yet. I don't know. Let's see. Maybe I do. Yeah, I already had it there. So that's okay. I hate the way this does this. It always leaves me in this place where I don't want to be. Let's see if I do it this way. It'll open properly for me. Okay, good. But I didn't open it with the annotator. Sorry, I should have probably done this before I forgot. Okay, if you're going to be, writing an essay while you're supposed to be in the class, go ahead and mute yourself, please. Okay, so let's go ahead and let's take a look at this. Okay, and so what I'm going to do, remember one of the items that affects our comprehensive income is unrealized holding gains and losses from available for sale securities. So I'm going to go through a couple years of transactions here with available for sale securities and see how they're going to affect my reporting of my other comprehensive income for the period and how they're going to affect my accumulated other comprehensive income. And then the other thing is what happens if I sell an item that had been affecting other comprehensive income, like an available for sale security. How will I do the reclassification adjustment? And then I'm going to go back and highlight that area that I skipped back on page 60. Okay, so let's just go ahead and let's take a look at this example. So company purchases an available for sale security in year one for $500,000. So I'm going to debit the asset available for sale security, of course, credit cash for $500,000. At the end of year one, the available for sale security has a market value of $600,000. Well, if it's an available for sale security, and we'll get to how you count for investments in equity securities in another chapter, but I think you probably remember from 100B Intermediate 2 that if that's the case, you would go ahead and increase the security up to its fair market value by debiting available for sale security for 100,000, which is what they do here and what I do here, and then credit unrealized gain on available for sale security for 100,000. Now that unrealized gain on available for sale security is going to be reported on the statement of comprehensive income. So right here, I give you an example of the statement of comprehensive income. And notice, like we saw in I'm using the two statement approach here. I start with what? I start with my net income of 50,000. I report that what? That other comprehensive income gain from available security. I'm preparing my financial statement, okay? That's getting what? That's getting credited to my OCI right there, that 100,000. I prepare my financial statement. I have what? OCI of 100,000. And then my comprehensive income, pardon the typo here, guys, should be what? Should be 150,000. I add my net income to my other comprehensive income. That gives me now comprehensive income of 150,000. The 50,000, I just made that number up. There's nothing in these journal entries that would have generated that. Question so far? Okay, now what happens? Then I have to make my closing entries, don't I, at the end of the year? And so when I make my closing entries at the end of the year, I have to close my OCI, because OCI is reported on an income statement type item. We call it the statement of comprehensive income. So what do? Just like if you were closing out your net income to your retained earnings, you debit what? You debit OCI and you credit what? Accumulated OCI for 100,000. Don't worry about that 300,000 yet. That's going to come in year two. But you can see how I close out my OCI to my accumulated OCI, just like I close out my net income to my retained earnings. Question. Okay, good. Then what happens? Then I come down and I have year two. And in year two, they purchase another security. And when they purchase that second available for sale security, they purchase it for $1 million. So they credit cash. And at the end of year two, they sell that first marketable security, the one they bought in year one, and they sell it for $600,000. And then at the end of year two, they realize that the security that they just bought in year two is now worth 1.4. So it's come up 400,000. So what happens? Well, when they sell the security from year one, the AFS one, marketable security one, of course, they debit cash. They sold it for 6, and they credit the security for 6. The security account for that particular one is closed now, right? It's gone. But now they have to make this reclassification adjustment. So when they do the reclassification adjustment, what they're going to do is they're going to debit unrealized OCI for the 100,000 and credit realized gain for 100,000. Now that realized gain will get reported on the income statement. And if you look at OCI for year 2 here, right now there's a debit of 100,000 in there. But they have to make the adjustment for the second security. So what's going to happen? They're going to have to debit security 2 for 400,000 to bring it up to 400,000, and they credit OCI for year 2 for 400,000. So if you were to look at their OCI for year 2, it's saying what? It's saying that it is 300,000. It went down by the reclassification adjustment. It came up by the 400,000 that it needed to, because that security 2 that we still had increased 400,000. So if you look at your year 2 statement of comprehensive income, what happens? Well, my net income is what? Net income is 100,000. That's that 100,000 gain right there. There's my net income, 100,000. My OCI, just looking at my T account, right? We use T accounts to prepare my financial statements. My OCI is 300,000. So my comprehensive income, my net income plus my OCI is what? Is 300,000. Now what? Now I want to go ahead and close my OCI. And so when I close my OCI, what happens? And I wrote it down here, but it's also up here. Let's go back to that original accumulated OCI. I would do what? I would debit my OCI to close it. That closes it out to 0, right? And then I go ahead and I credit my accumulated OCI for 300,000. So the accumulated OCI shows what? Shows 400,000, which it should show 400,000, because right now the difference between what I paid for that one security I have left and what was in the accumulated OCI should be 400,000, right? It was just the way I got there by reclassification adjustment for things that I sold, etc. Okay? Question? Okay, good. So let's go back to the outline. How to get out of this? Okay, let's go back to the text here. Okay.
There's a tab, like below, a little bit down. Yeah.
Oh yeah, got it. Thank you. It was there somewhere, but I was getting hypnotized by that other thing up there. Thank you. Okay, very good. Thank you. Okay, so let's go ahead now and let's just go back to the outline. And I think we understand now a little bit better that the accumulated other comprehensive income is a component of equity that includes the total of other comprehensive income for the current period and all previous periods, right? The 100 plus the what? The other comprehensive income for 300,000 in year 2. Other comprehensive income for the period is closed to this account, which is reconciled each period similar to the manner in which retained earnings are reconciled, whatever that means. It's like retained earnings, I don't know about reconciled, okay? Then what? Reclassification adjustment move other comprehensive income items from accumulated other comprehensive income into the income statement. Now, you know, it makes it sound like you did some entry there in the accumulated other comprehensive income. That's not quite how it happens. We do what? We sold off that that first security. We sold it off, and we sold off for 600,000. We got rid of the security, but then we did what? We debited the OCI, credited regular income, and then, yeah, once we closed the other comprehensive income, we closed it to accumulated other comprehensive income, which essentially took that 100,000 that was sitting in accumulated other comprehensive income and took it out, right? But the reason the book writes it this way is sometimes questions say it that way, because I guess that's the way FASB wrote it. But the reality is more of those journal entries that we just looked at a couple of seconds ago. Okay. So with all that, now we have looked at what we have looked at just going forward now. We have looked at single statement approach. The example that I was giving you was the two statement approach where we just brought the net income in, those little things I wrote on that example. And then let's go ahead and take a look at some of the required disclosures here. Okay. So what are the required disclosures? And let's flashcard these because I do see questions on these. Okay. So the required disclosures, we have to disclose the tax effect of each component of other comprehensive income. We didn't see that on the face of that other comprehensive income statement, but somewhere you'd have to figure out what is the tax effect of these different comprehensive income items. Okay. The changes in the accumulated balance of each component of comprehensive income. Okay. And again, you don't have to call out the detail of each item like you saw in that example in the one statement approach, two statement approach. They called out the pension, they called out the unrealized, but somewhere, if you didn't put it on the face of the statement of comprehensive income, you would have to disclose somewhere what the changes were for the period for each component. Okay. The changes in the accumulated balances by component may be shown. Oh, there it is on the face of the financial statements or in the notes. That's what I just said. Okay, then what? Then the total accumulated other comprehensive income in the balance sheet as an item of equity. So that accumulated other comprehensive income would probably be up there somewhere near retained earnings as part of my stockholders' equity, and you would report that on the balance sheet. Okay, now let's go ahead and let's box off this part down here. Okay, and let's make this part a second flashcard. I could have you just do it as one, but I want to box this part off. Okay. And so what happens? The reclassification adjustment, I want to highlight that. Now I lost my box. Okay, let's highlight that. The reclassification adjustment, which are made to avoid double counting in other comprehensive income items that are displayed in net income for the current year. Okay, it's FASB speak. That's FASB speak. Okay, remember, FASB are people that, you know, were the accountants, and sometimes they can't get out of their own way in the way they describe things, and then everybody's like, what the hell does that mean? Okay, so what's going on here? What they're saying is you have to what? You have to sit there and do that reclassification adjustment where you debit OCI and credit the gain when you actually sold that security for the 100,000 gain. Otherwise, you're going to do what? You did nothing. You would still have stuck in your accumulated other comprehensive income the gain you took in year one, and you would have in retained earnings what? You'd have in retained earnings the 400,000 from this year's gain on that one security, that second security. So what you need to do so that you don't double count it as part of your accumulated OCI and part of your retained earnings, you have to class it out of OCI, debit OCI, that'll get it out of accumulated other comprehensive income, and then you'll just report the actual gain, the realized gain from selling that, where it belongs in retained earnings, so that you're not counting it in accumulated other comprehensive income and retained earnings at the same time. That's what they mean, okay? Also, disclosures, changes in accumulated other comprehensive income by component, and significant items reclassed out of accumulated other comprehensive income must be disclosed either on the face of the statement or in a separate disclosure in the notes. And what I want you to put here is see page 64, okay? And let's just go ahead and see what that disclosure would look like. And that's this right here. Now, what I'm going to do, because what's happening is Becker made the mistake of making this overly complex by having a couple of different other comprehensive income items in here. And meanwhile, we haven't talked about any of them really yet. So what I'm going to do is I'm going to tie this example or this presentation to the example that we just looked at, the one I gave you. So what happens? For our other comprehensive income, in the little example we had a beginning balance of what? 100,000, didn't we? Then what happened? Then we had other comprehensive income before reclassifications. Well, that was 400,000. That was just the difference between that second security, what we had bought it for, and what was being valued at by the end of the year. Then what? Then we had the reclassification adjustment for that second security, in which we needed to take it out of accumulated other comprehensive income. We did that by debiting OCI. And then when we closed OCI, it took that amount out of the accumulated comprehensive income. And that amount was what? 100,000. And so that we ended up with what? The 400,000. And by seeing that disclosure, now the users of the financial reports, right, have some better information. Let's see if I can find my little example again without going nuts here. Okay, if we go back to that little example, if you were just looking at the other comprehensive income statement, all you would see is what? 300,000 of OCI, because there was the amount that came out and the amount came in. 100,000 went out, 400,000 came in. You'd say, oh, okay, your OCI was 300,000. Meanwhile, it wasn't quite that way. There was some of that got taken away. There was 400,000. Some of it got taken away by that reclassification adjustment of that 100,000 for that security that we sold, as we took it out of accumulated OCI and wanted it to be reported into retained earnings. So to handle that, we provided you this disclosure, didn't we? Now you can see everything that happened. Oh, okay, you had 400,000 for stuff that you kept, but stuff that you got rid of where you had to make the reclassification adjustment, that was 100,000. And so I see now where the 300,000 on the other comprehensive income statement comes from, and I see how you ended up with 400,000 in your accumulated other comprehensive income. Okay. Question. Okay, I'm not going to worry about that disclosure down there. So if there are no questions, right, why don't we go ahead and take a look at this question 1 for tonight. And I'll go ahead and put the poll up. And I'll give you a minute and a half for this one. Okay, why don't we go ahead and look at this one? I think most of us right now got this correct. Okay, 68% of us anyway who tried it got it right. Okay, the answer is C. And remember, we said that what? It's the change in net income, not in income, in stockholders' equity from anything other than from owner sources. And I had you write in there, not dividends and not stock sales. So the answer that is not, they say, which of the following is not part of comprehensive income? It excludes it, is the dividend, right? Now, when you look at this, though, let's look at some of the other choices and see what we hear about these, okay, what we understand about these. So let's just take a look. Loss from discontinued operations. That's part of net income. Net income is part of comprehensive income, so we know that's not it. Prior period error correction. Well, what happens? If I made a mistake in a prior period, what am I going to do? I'm going to sit there and I'm going to make an adjustment to the beginning balance of retained earnings. So basically, that's not from owner sources. That's a change that happens because I misreported something that should have hit income in a previous period, right? So that is not something that is from an owner source. We know the answer is D. Unrealized loss on investment in a non-current marketable security. If you pick that, I guess I won't get my feelings hurt, but we just went through an example where an unrealized loss on a marketable security was part of my other comprehensive income. And so that is obviously not part of comprehensive income. Comprehensive income is net income plus other comprehensive income. Okay, so you can see, guys, why I had you flashcard not dividends, not stock issuances, because it can get a little bit tricky as to how they're showing you these sort of non-owner sources things. It's dividends and it's issuance of stock are really the owner sources that could change equity. That wouldn't be part of comprehensive income. Question? Okay, good. Let's wrap up chapter 1 finally, right? We're a little bit behind, but that's okay. Okay, and let's jump ourselves to module 8 here. Okay, so what's happening? I hate to keep talking about that damn Facebook thing. I should have never joined that thing. Okay, but maybe it's good because I hear things through there. And the one I keep hearing is, so what are the journal entries I need to know for the exam? And people keep asking that. I'm like, what are you talking about? What journal entries do you have to know for the exam? You have to know how to do journal entries, for crying out loud. I'm like, I don't understand that. Now I do think that maybe there's some folks that maybe focus on tax that don't deal with journal entries as much. So if you need a refresher on how to increase assets, decrease liabilities and whatnot, talk to me and I have some things that I might be able to help you out with to help you with that. But it's not like, there's a set of journal entries that you have to memorize or something. You have to know how to make journal entries. And one of the type of journal entries you have to know about is how to make adjusting, correcting journal entries. So what happens? Entity makes a mistake. How do you correct the mistake they made? Entity forgets to accrue something at year end. How do you correct that? How do you adjust that? How do you fix that so that you accrue at year end? Okay. And so they go through a variety of entries here that would be made to make these kind of corrections. But I think it's better to look straight to the example that we have here so you start to understand the nature of adjusting entries and how you think through those, rather than for me to sit here and read off a bunch of journal entries with X's on them to you, okay? So what I want to do is I want to jump you all the way to, and I don't want to walk through all those fact by fact. I want to jump you straight to here because I think this is a good exercise. Not that it is the exhausted list of what journal entries do I have to know for the exam. No. That's not how it works. You have to sit here and you have to understand the thought process for the journal entries that you'd be making. And in this case, adjusting or correcting journal entries. Okay. So let's just go through these and let's talk through these. Okay. What happens? They tell me that a company purchased, listen, I'm just looking at this first one now. Okay. They tell me that a company purchased a $300 3-year insurance policy on 1/1/2 and expensed it all on the payment date. Is that what you're supposed to do? No. If you have what, a 3-year insurance policy, then you should have taken what, 100 a year, 100 per year as expense and credited the prepaid as you went along, right? So at the end of year 1, the amount of expense is only what? Not $300 because they debited all to expense. The amount of expense is actually what? $100. So how do I fix that? Well, I fix that by debiting prepaid insurance. Is it insurance that we're dealing with here? Yeah, prepaid insurance, what? 200, and I credit insurance expense 200, right? And when I do that, now the insurance expense is showing what? Is showing 100, and the prepaid is showing 200 because I still have 2 years to go on that policy, right? You see what I'm talking about, guys? This idea of what journal entries do I have to know? You have to know how to make journal entries. And you need to be able to read the fact pattern and figure out what the correct journal entry is. There's no like exhausted list of journal entries that finite list of journal entries that you have to remember. It's what you have to know how to make journal entries that will, in this case, make a correction or whatever else it is. I mean, we'll deal with journal entries when we talk about governmental accounting. You got to know the right journal entry for the right situation. It's not like there's just a list of journal entries you got to know. Okay. Question on that one? Okay, good. Let's look at this number 2. 2,000 of credit sales made during the year were not recorded in the ledger because they had not been collected in cash. Well, collecting in cash under the accrual system is not what triggers the recognition of revenue. Is have you earned the revenue, right? So just because you haven't corrected that doesn't matter. You still need to debit accounts receivable for 2,000 and credit sales or revenue or whatever for 2,000, right? Isn't that the correct journal entry there? Okay. All right, good. And I'm sorry if I'm not lining these up the best. It's kind of hard to squeeze them in there, but let's look at number 3 now. Okay. So cash totaling 3,000 was received in advance from a customer, from customers. Cash totaling $3,000 that was received in advance from customers was recorded to service revenue. Only 30% of the services had been performed. Well, if that's the case, what? Then yeah, 3,000 times 30%, 900 should have been revenue. The remaining 2,100 is unearned, isn't it? So how do I fix that? Well, I'm going to have to sit here and I'm going to have to debit revenue for what? 2,100 and credit unearned. That says unearned revenue. Sorry, I have to squeeze it in there for 2,100, right? You see that? Debit revenue 2,100, credit unearned 2,100. Is that the correct journal entry there? Right? Okay, good. Then what? Then we look at number 4 over here. And number 4, the accountant discovered that a $450 utility bill covering the month of December had not been entered into the accounts payable system. Not too bad on that one. I'm going to debit expense, utility expense, whatever. How much was it? $450, and credit account payable for $450. Okay. Okay, good. Number 5. Stop me if you have a question, guys. 4,000 of rent was prepaid on year 1, covering a 4-year rental period. No entry was recorded in year 2 related to this payment. So if it's a 4-year, 4,000, of course, divided by 4 is 1,000 per year, right? So I would have had to have debited rent expense. I paid it in year 1, debited rent expense for 1,000, and I'm assuming they had set up the prepaid rent, I guess. in the previous year, although since they're so sloppy with their accounting, who knows what they did with the year one amount. But assuming they set up a prepaid rent for in year one, then I would have credited prepaid rent. Number 6. The direct write-off method was used to write off a 650 bad debt in year 2, although the company uses the allowance approach to estimate its bad debt. Well, if I had a bad debt that I had set up for an allowance for in a previous year, at the time of the sale, I would have set up the bad debt expense and credited the allowance. I don't wait until I actually have the write-off. When I have the write-off, then what? Then I need to go ahead at that point and debit the allowance for the 650. And since I made the mistake of doing what? Since I made the mistake of debiting the bad debt expense for the write-off, then at this point, I'm going to have to do what? I'm going to have to credit the bad debt expense for 650. Okay. Don't write this down, guys. What they did, this is the wrong that they did. Bad accountant. The wrong that they did, I'm putting wrong on there because I don't want you to think this is what you're supposed to do. What they did was they did what? They debited bad debt expense at the time of the write-off for 650, and they credited accounts receivable for 650 at the time that they had the write-off. No. The bad debt expense would have been set up when they had the allowance. So they have that amount sitting in the allowance waiting for the write-off. So the correct entry would have been to do what? Debit the allowance, credit the account receivable. Well, they got the credit right here, but this debit is wrong, isn't it? So what do? I reverse that wrong debit by crediting it, and I put this proper debit in here, which should have been the debit to the allowance. Okay, question? Okay, good. And then this one's, kind of annoying. They bought inventory and they didn't record the inventory. So just debit the inventory for $1,300, credit account payable for $1,300, whatever. And then they're sitting there, number 8, the company purchased available for sale security during year 2. For $1,500, the fair value at the end of year 2 is $2,000, but they hadn't made any adjustments. So go ahead and debit AFS security for $500 and credit what? Unrealized gain. And that's going to be reported where? That's part of my OCI. Put OCI in there, unrealized gain. And that would be reported on my statement of comprehensive income?
Yes.
Okay. Good work, guys. All right. Again, you're probably sitting there saying, thanks a lot for giving me writer's cramp, John, because all of those same entries were on the next page. Okay. But it's easier to see them when they're right next to each other like that. So you can see they also gave you the journal entries here for that. But you should be good at dealing with these adjusting entries. You're a CPA, right? So you're the doctor that cures financial statements. How do you cure sick financial statements? You make correct journal entries that get them to correcting journal entries that get them to where they want to be. So it's fair game on the exam. That is a set of journal entries you're going to have to know. Be comfortable with that material, please. Okay. All right, good work, guys. Let's go ahead and try one of these type of questions, okay? And that could be, by the way, task-based simulation. They could give you task-based simulation just like that and ask you to make you set it up at correcting, adjusting journal entries. So you got to know your way around those pretty good, okay? Okay, excellent. Let's go ahead. Let's relaunch our poll. And this one's a little more involved. I'll give you 2 minutes. There was some movie where the person, they said they were going to destroy the enemy And then the person said, can I have 1 minute to inform my crew? And then the mean guy says, I'll give 2 minutes to you and your crew. So I'll give you 2 minutes to work through this question, see how you come up with the answer. Okay, guys, so 2.5 minutes. So go ahead and wrap up your answer. Okay, and let's take a look at this one. Okay, we're at 75% for the right answer, so we're doing okay. I'd say this question is probably a medium difficult question. Okay, the right answer is B. But let's just walk through the logic here as to what the correct journal entry would be. So at October 31st, okay, the company with a calendar year end. That's very annoying. Calendar year end is 12/31, okay. Paid 90,000 for services that'll be performed evenly over the 6-month period from November 1st through November 1st, year 1 through April 30th, year 2. The company expensed the $900 cash payment. Now, wait a minute. This thing's going to benefit future periods, isn't it? They did this. They debited expense, what is it, 90,000? And credited cash, 90,000. Is that what you're supposed to do? No, right? So we know we're going to have to fix that. But I'm going to go ahead and I'm just going to put expense is sitting there at 90,000. And I, as CPA, need to know how to fix that problem. What happens? This thing is going to benefit a 6-month period. So what's going to happen? It's really only going to expire, what? A month at a time. 90 divided by 6. That's 15,000 per month, isn't it? And if they paid for the thing October 31st, then by 12/31, all of November, all of December, what's happened? Only 2 months have actually gone by. So actually, my expense for this year 1 is 30,000. I got 90,000 sitting there, don't I? So how can I fix this? Debit or credit? CPA is sitting there and you've got the enemy. The enemy is the improperly reported financial statements, and we're going to destroy the enemy. And they give you tools, and those tools are debits and credits. How much do I want the expense to be?
30.
30. How do I take a 90,000 debit and turn it into a net 30,000 debit?
Credit 60,000.
I have to credit the expense 60,000, don't I?
Yeah.
Now it shows 30,000. Isn't that beautiful?
Yes.
And I have to do what? I have to debit something, don't I? I know something's got to be debited 60 because I know if I credit something 60, I got to debit something. What do you want to debit?
The prepaid service.
I have the prepaid that I'll debit. That is a what? Asset, future economic benefit. To increase it, I debit it because I'm going to use that service up next year, right? In year 2 in this example, I guess. So is it true that I debit prepaid services and credit expense for 60,000?
Yes.
Okay. That's you got to do that weightlifting, guys. You got to go through that weightlifting for the exam. Some things I can just give you flashcard for. I call the flashcard the jogging, right? Repeat with that enough times and you'll get the cardiovascular and you'll be able to run 3 miles on the day of the exam. This stuff is weightlifting. This is, you got to develop your thinking about that so that you get more and more comfortable with this kind of thinking. And I can't give you a flashcard for that. You need to practice with this. You need to do your weightlifting on this. Okay. Okay, excellent, excellent. We are in good shape. I want to go ahead and take an earlier break so that you can get chapter 2 together if you don't have it in front of you, okay? Because we're going to move into F2. So get that in front of you. We'll take the break a little bit early. Here we'll take 10 minutes, so we'll come back at 6:10, and then we'll push through the end to get through as much of chapter 2 as we can. All right? Sound like a plan?
Yes.
Okay, guys. I'll see you in about 10 minutes.